everyone. Welcome to the Linda Lowdown podcast number 2. Today I have she was my client, Kiona. She's been an accountant for quite a few years. She's my accountant and some other of my friends and realtors. So I thought I would interview her about tax breaks for homeowners, buyers, sellers, and even realtors. So I have a bunch of questions to ask her, and we'll get it started, and hopefully it'll help you guys. Okay, so first we're going to work with selling a home.
Okay.
When someone sells their primary residence, do they automatically owe capital gain taxes, or are there exclusion homeowners should know about?
Okay. So no, when selling their primary home, they do not automatically have capital gains. You have what they call gains exclusions, and those are up to $250,000 for someone that's single, or if you are married, up to $500,000. So it's called Section 121 exclusions, and then there are a couple rules to qualify for those exclusions. Of course, to qualify, you have to pass a 2 of 5 rule test, which basically it's 3 things: owned for at least the last 2 years, lived in as primary for at least 2 years, and then during the 5-year period before the sale. So it doesn't have to be 2 consecutive years. It just has to be within a 5-year period, 2 years that you've lived in it to get that exclusion.
Okay, great. And that is always something when I'm at closing, they buyers or sellers are always worried about. And so I always just tell them to talk to their accountant, but usually that question is answered at closing.
Yeah, which too, like to give an example, like say you paid $200K for a house, then it sold at $450K. So the gain would technically be $250K, but because if you qualify for one of those 3 things, that $250K exclusion is no capital gains, so you're not taxed on it.
Okay, I didn't know that. All right, next question. What are the biggest tax mistakes people make when selling a home?
That's where a lot of money gets lost. Actually, so one of the biggest mistakes is not tracking improvements. So I mean, I'm not talking about painting your house. I'm not talking about the little everything day wear and tear things, but I'm talking about new roof, new HVAC, full remodels, additions onto the home, new windows. If you upgrade your windows, if you finish the basement. So whenever you make major renovations to the house, a lot of people don't track those, and you should, because those are things that you can write off when selling the home. Another people get like I said, confused when it comes to repairs versus improvements. So painting, fixing a leak, doing minor plumbing, that's not a major improvement.
Mm-hmm.
So basically, if it prolongs the life of the house or it adapts the home to a new use, like say you put a handicap ramp in, then you can depreciate certain things, and then those depreciations can be taken off of your tax. And it's just so basically the major thing that people forget is that to keep track of their improvements and keep their receipts.
So then the next question was, what documents or records should homeowners keep while they own their home to protect themselves at tax time? So one would be the major improvements, but is there any other documents that they should keep?
You should definitely keep your major improvements and your receipts. You should keep your opening and your closing paperwork, because certain things like that are used when you're selling your home.
That's about it.
But
okay.
Definitely improvements.
Okay. So then the next one is about owning a home. Okay. So what home related expenses are actually tax deductible, and what do people wrongly assume is deductible?
Okay, so that's another major one, because I get a lot of questions about that. So a lot of people are like, well, I got my mortgage interest, I have my taxes, I get a certain deduction for that, or I get a certain write-off for that, don't I? And the thing about it is, if it's not over your standard deduction, then it doesn't really help you. So the main thing is, but you want to keep your mortgage interest for primary and secondary if you are able to itemize. So the biggest thing is all those things have to add up to more than what your standard deduction is. So property taxes, you can get up to a total of $10,000, and that includes state and local taxes as well. If you have a home office, business use only, those are things you should keep because you get a write off for that. But it has to be regularly and exclusively used for business or Schedule C activity. A percentage of your utilities, your insurance, repairs, depreciation, all of that is able to be written off as well if you have a home office. And a lot of people get confused with that. So keeping the square footage of your home office versus the square footage of your house and just keeping records of everything you're doing for that home office is very important.
Okay. What tax advantages does owning a home give someone compared to renting?
Okay, well, that's another good one. So owning a home versus renting. If you are able to itemize, then those deductions, mortgage interest, because there's no mortgage interest if you're renting. Being able to write off your property taxes because there's no property taxes if you're renting. Home energy credits if you're upgrading, if you put satellite or
the solar panels?
solar panels on your house. So stuff like that you can't do if you're renting, because then too, a lot of people sublet their homes. So if you're renting your house out, then you get rental deductions on a Schedule E as well, and those are things that renters themselves can't get versus homeowners.
And plus with renting, if you make those they can't make major improvements, so that doesn't help either with their
correct
tax deductions. Okay, so now we're going to talk about investment and inherited properties.
Okay.
How does owning a rental property change someone's tax situation?
Well, owning a rental property changes someone's tax situation. Number one, you claim the rental income, but if you do any improvements to that rental, if you're paying taxes on that rental, if you're paying insurance on that rental, those are all things you get to write off on your Schedule E. Depreciation, which is very powerful and is sometimes often misunderstood. But depreciation is a big thing when investing in real estate and having rental properties. And it carries over for sometimes 23 to 27 years, depending on what you're depreciating. And that helps in the long run.
Okay. Yeah, I think you do some of that for me.
Yes.
All right. Next question. If someone inherits a home, what tax implications should they immediately be aware of?
Okay. Well, when inheriting a home, it's called a step up in basis, which is actually a big benefit if you inherit a home. You have to be aware of it because a lot of people, when you inherit a home, you don't automatically get that home appraised, but you should. The minute you inherit a home, get it appraised. Because the biggest thing is, like, say the original value. So say your parents bought a house in 1990. The original value was $100,000. At death, say they died 30 years later. At death, that house might be worth $400K. So with the heir, they won't be taxed on the $400K that it sells for. They will be taxed on the realized gain. So basically, say that house was originally $100K, it's valued at $400K, they sell it at $410K. The only taxable is the gain of the $10K because it's now appraised at $400K. So you're not going to tax me off the $100K that I originally purchased it for. So that the $310 difference is a big difference, and a lot of people won't catch that if they don't automatically get that house appraised when they inherit it.
Okay. Is there any changes now with like at closing? Like, I thought there was something that came up now that they changed, that the government is asking for when people inherit the home. I think they have to file some other documents, or is that just, maybe that's just at closing? There's nothing new for taxes, is there?
No, nothing new for taxes at closing. There's some different paperwork that the closing handles.
Yeah, it might just be the closing part. Okay, so now we're going to switch gears.
Okay.
Well, wait, do you have anything other for people that own a home and buy a home, or buying a home? Any other suggestions or anything?
No, I mean, the biggest thing that I have to keep pointing out is just save your records. A lot of people do not save their records, and it's very, very important.
Yeah, mine are all in a box. I can bring you my box and here you go look for them. Okay, so now we're going to switch gears and we're going to go to realtors and business owners. Okay, so this is for a realtor getting started in the business.
Okay.
What are the biggest mistakes brand new realtors make in their first year?
Ooh, not understanding self-employment taxes. So, and what I mean by that is say you come from a job where you're receiving a W-2.
Mhm.
So your job is automatically taking out your taxes for Medicare. They're automatically taking out your taxes for Social Security. In most cases, they're taking out your state taxes, your city taxes, and your federal taxes. When you're a realtor, you are your own boss, so no one's taking those taxes out for you. So the biggest mistake is not realizing, like, hey, I have to handle taxes differently.
Right.
So now, depending on what I make, I might have to pay estimated taxes. Now, depending on what I make, I need to set money aside for the end of the year because I'm going to owe something.
Yep. And that's what I do. So when I get a paycheck, like so much goes into my checking and the rest I put into a savings account just because, years ago I got in trouble with not paying my taxes when I was a new realtor and it was a nightmare. So I will never do that again. So I suggest anybody that's new in the business to definitely open up a separate account and put that money aside and don't touch it. Like, don't touch it.
Right.
What expenses should every realtor be tracking from day one?
Well, definitely you want to track mileage. Mileage is a big thing with realtors. You guys drive to meet people. You drive all over the place, even if you're not selling anything. So tracking mileage is going to be one of the biggest deductions for a realtor.
Did they up that this year?
Yes. Every year they add a couple more cents to what you can deduct. So I believe it's up to 70 cents now.
Okay.
And so every year they add a couple more cents and it gets better. So, but definitely you want to be tracking mileage, education and training when you're paying for your real estate license, when you're paying to go to classes or go to conferences. Track those traveling expenses, track those what you're paying for those classes, all that you're able to write off. Car expenses, like I said, as far as mileage, home office. If you have an office at your home that you're working out of, track those expenses because a portion of those expenses are able to be written off. Your MLS fees, because I know you guys have listing fees, association fees, any type of fees that come with being a realtor, that come with doing your job, you should be tracking because you can write all those things off.
Yeah, and office expenses, like if you buy supplies and things like that, you
Yes.
can write those off.
Paper, ink.
Yeah. And then your laptops and your computers and all that
Yeah.
stuff. So there are quite a few deductions. Trust me, I try to do every single one that I possibly can.
Yep. And with that mileage, keeping a log because the IRS wants it to be written. So whether you're logging it by hand or you get a app like Mile IQ or something like that that's free, just make sure you're tracking it and keeping documents.
Yeah, I just got that app, Mile IQ. That's what I'm using this year. Okay, at what point should a new agent hire a professional accountant instead of trying to do it themselves? Like that first year.
Yeah, absolutely. I love that question because I get so many people, and it's surprising because I give out free advice all the time. I don't like to gatekeep. If I can help you, I'm going to help you. But my answer for that would be the minute that you don't know where something goes. Like I've had somebody call me like, "Oh yeah, I'm doing my own taxes. I don't see this form. Can you tell me where this goes?" That's a red flag. You need a professional. If I have to tell you where it goes, you need me. You don't need to call and ask me. You need to come see me.
And trust me, I've had sent my children to use her, and she was so good with them. She was like, gave them suggestions and then said, do your own taxes. Like,
Yeah.
And my brother who lives in PA, he absolutely loves her too. And he's like, where's that form? Because she has a specific form that you just have to fill out when you do your taxes. And it's really easy. And he absolutely loves it. And he uses it over there for his accountant there. So
Yeah, I appreciate that. But yeah, I'm a people person. So my thing is I like to be fair. So if it's something simple that you can do on your own, going to be honest with you, like, hey, go do this for free. I'm not going to charge you.
Mhm.
But if it's something you need me for, I'm going to be honest with you about that too. So
Yes, and I like the honesty. Okay, so next section is about tax strategy and business structure. When should a realtor consider becoming an LLC or an S corp?
okay, so LLC immediately. The minute you decide you want to become a realtor, get you an EIN number, pay the $99 if you are in the state of Ohio. If you're in a different state, your fees are a little different. Pay the $99, become an LLC immediately, because it's going to put you in a better position and it's going to protect you. And now, as far as becoming a corporation or S corp, depends on whether you have children that are under the age of 17. Because if you're still getting, some earned income credit, or you're still getting some child tax credit, then it wouldn't be helpful to go to a corp. But if you don't have children, and you're making over $500,000, then I would consider going over to S corp and paying myself with a W-2, because it'll make your taxing situation a lot better.
Okay, yeah, I'm still at the LLC. How do quarterly taxes work for 1099 agents, and why do so many realtors get behind? Oh, I know.
Well, the estimated taxes work. Say you come and you file your 2025 taxes. I'll see that you owe. I'll plug that formulation into an estimated tax form, and then I'll send you vouchers. You'll get 4 vouchers, and it has dates starting with April 15th of 2026. It'll have 4 different dates. It'll be quarterly. You send those in with the vouchers. At the end of the year, you're usually good. If you paid too much, they'll send you your money back. If you didn't pay enough, then you'll still owe a little bit. But that's how those vouchers work. And I think the reason a lot of people get behind is they ignore them and they don't pay them. Or instead of paying them quarterly like they should, they send a one-time payment in.
That would be me. Yep, that's me. I just see what I make on interest, and I'm like, oh, I'll just make some extra interest and
Right.
then send my payment in. You can see she gave me the side eye, so she knew. What's one completely legal strategy realtors can use to lower their tax bill?
Pretty much all of the things I mentioned, keeping all of those expenses, like the little things that you wouldn't think to keep, like you're in between clients and you stop and grab McDonald's, you're eating on the job, you're eating on the go in the middle of a transition. Keep your receipts for that. Then you're able to write that off. So the biggest thing is tracking that mileage and just the little things that you wouldn't think you're able to write off. If you buy a pack of pens to do your job, keep your receipt, track that expense. If you buy a pack of paper, like anything you're doing to help you do your job.
I was just thinking, so there's the mileage and there's the gas. Usually the mileage is better
Yes.
than writing off your gas receipts.
Absolutely.
Yeah, because I don't even say my gas receipts
And
anymore.
mileage will always be better. So I tell people, don't even worry about those gas receipts. Just make sure you're tracking that mileage.
Okay. What purchases do realtors often think are deductible, but actually aren't?
Going to get your car washed. If you're tracking mileage, then there are certain other deductions that aren't available. And like I said, mileage is always going to be better. So you can go get your car washed 4 times a week, and we're not going to be able to write it off if we're writing off mileage.
Well, can I claim it as something else? Car repairs? From your perspective, what separates realtors who build long-term wealth? I'm sorry, I messed this up. See, I told you I'd mess it up. So now we're going into growing and building wealth. Okay. What bookkeeping habits separate financially successful realtors from those who can constantly feel behind?
Actually keeping record. Because a lot of people, they don't keep records, and then at the end of the year, they're cramming. So being successful would be actually taking the time to do the records. Whether you do it on a daily basis, a weekly basis, or a monthly basis, just make sure you're staying in contact with your records, making sure you're not getting behind, you're not losing track, because then that's when you'll miss something.
Do you have a specific program that you would suggest people to use? I know I use QuickBooks and it changed a lot and it frustrated me, so I quit using it. And plus some of the banks don't mingle with QuickBooks because they call it's a chance of embezzlement or hacking.
Okay.
So they don't, like CSC does not do that.
So my biggest thing, QuickBooks is a good one if you know how to use it. Using something as simple as an Excel spreadsheet. It's free to use. It's easy. You can tag in your own formulas. And now with GPT, it'll help you kind of create those formulas and make it easy for you. Also, what I do as a business owner, and what I even suggested to you, is get a American Express business card or get a Discover business card, because both of those are really, really good. And just use that card for everything business related. And then at the end of the year, they do an end of the year summary where they actually, this was meals, this was hotel stays. Like they
Break it
section
down.
it out and break it down for you, and you know exactly what you spent where.
That reminds me, I have to print that out for you. So I can turn it in my taxes. From your perspective, what separates realtors who build long-term wealth from those who just chase commission checks?
Being a people person. Because I think that's what drew me to you. When I first met you, you were a people person. You were honest with me. If we went to a house and something wasn't right, or you felt like once you got to know me, you felt like it wasn't for me, you were honest with me. And so I think people tend to be drawn to people like that because they know that they can trust them. And so then you'll build your clientele. So I think just the record keeping, being a people person, and then just putting yourself out there determines the people who are in it for longevity versus people who kind of fade out or end up quitting because they don't have the clientele that they like.
Okay, so we're end of all the questions. So now I'm going to put you on the spot.
Okay.
So tell me some stuff about you. So I know you're a referee. And then you have your own food truck.
Yes, ma'am.
And then you do charity work because you went to Kenya and Kenya?
Yes.
And what was that mission called?
So that's Destiny to Journey, Destinies to Journey, Journey to Destinies.
One of them, right?
Journey to Destinies, and they don't just go to Kenya. There are probably about 7 countries that they go to. The group was just recently in Panama. They go to Ghana. They actually just opened up a mission in right here in the States in Tampa, Florida. So it's not just one place, but we try to travel to places that are legitimately in need. And when I say legitimately in need, like yes, we have need here, and we do charity work here, but here we also have the means to go get it. Mm-hmm. And a lot of those places we travel to and we minister in and we help, they don't have the means to go get it. And so
yeah, because when she was in Kenya with her family, she put out a little text message that was kind of like a what was the word?
Like a call to action.
Yeah, call to action. So she was trying to raise $1,000. Yes. Because when they needed transportation to get back and forth to work, and so you ended up raising that, right?
Yes.
And so and I helped participate in that, but I bribed her, and she said she actually bribed me, but it's okay. And so she was able to give them a dirt bike, a motorcycle.
Yeah, we were able to get a brand new motorbike for that family, and because of that, he was able to start a business to sustain and feed his family every day. So myself and my mom, we donated the large bulk, and then we got other people to help donate the other 1,000 we needed, and bought a brand new motorbike. I mean, it changed that family's life. So.
Yep. You want to tell them where you're located? Yep.
So we're located at 1124 McKinley Avenue Northwest, right across the street from the Walgreens on 12th Street. That's where our tax building is located, but we also have the food truck in that parking lot. We travel, we do events with the food truck. Some of the best soul food you'll ever taste.
And I forgot, what's the name of your accounting firm?
Chosen One Consulting, LLC.
Okay. All right. And another thing is we're going to be putting on that home buyers seminar here in a couple weeks at the office, and Kiona is going to be one of our our speakers there. So if you would like to come for that too and meet Kiona and talk to her about taxes, you're more than welcome to. So, well, that includes today's podcast. I hope that was helpful. If you have any other questions, you can reach out to Kiona. I am going to put her information in the post, so you can contact her. And I hope everybody has a great day. Thanks for listening.